Have you ever wondered if a company is better off borrowing a ton of money or just using its own cash to grow? It's a huge question in finance, and for a long time, people argued back and forth about it. Then, two brilliant economists, Franco Modigliani and Merton Miller, came along and blew everyone's minds. They came up with something called the Modigliani-Miller Theorem, or M&M for short. And today, we're going to break it down in a way that actually makes sense. So what's the big idea? In its simplest form, the M&M theorem says that in a perfect world, it doesn't matter how a company finances its operations. Whether it uses 100% equity from shareholders or borrows 90% from the bank and uses only 10% of its own money, the total value of the company remains exactly the same. I know what you're thinking. That sounds crazy, right? How can taking on a bunch of debt not change a company's value? To understand this, let's use a simple analogy. Imagine you want to buy a pizza. The whole pizza represents the total value of a company. Now, you can slice that pizza however you want. You can cut it into 8 equal slices, or you can cut one giant slice for yourself and leave a bunch of tiny slices for everyone else. Does changing how you slice it change the size of the pizza itself? No, of course not. You still have the same amount of pizza. In this analogy, the pizza is the company's value, and the slices are how that value is divided between debt holders and equity holders. The debt holders are the people who lent the company money, like a bank. They get a fixed, predictable slice. The equity holders are the owners, the shareholders. They get whatever is left over. The M&M theorem says that no matter how you slice it up between debt and equity, the total size of the pizza, the company's value, doesn't change. The company's value is determined by its assets and its ability to generate profits from those assets, not by how it pays for them. Now, here's the crucial part. The M&M theorem works under a set of very strict, perfect market assumptions. What are these? Well, first, there are no taxes. Second, there are no bankruptcy costs. This means if a company goes bust, it costs nothing to sort things out. Third, everyone has the same information. And finally, investors can borrow money at the same interest rate as the company. This perfect world is where people get hung up. They say, but we live in the real world. We have taxes. Companies go bankrupt. These assumptions are unrealistic. And they are absolutely right. In the real world, these things matter a lot. For example, in most countries, the interest paid on debt is tax deductible. This creates what's called a tax shield. Because the company pays less in taxes, more value is left over for its investors. Suddenly, taking on debt looks pretty attractive because it actually increases the total value of the firm. This is what Modigliani and Miller showed in their later work. When you add taxes to the model, debt financing can increase a firm's value. So if the original theorem only works in a fantasy world, why is it so important? Why do we still study it? Because it gives us a powerful starting point. It's a baseline. It forces us to ask the right questions. If a company's financing choice does seem to be creating value, the M&M theorem tells us to look for the reason. Is it because of taxes? Is it because of lower borrowing costs? Is it because it sends a signal to the market? It isolates the real-world imperfections that actually drive value. It tells us that the magic isn't in the debt or equity itself, but in how they interact with real-world factors like taxes, bankruptcy risk, and information asymmetry. Think of it like a physicist first explaining motion in a vacuum to ignore air resistance. It's not realistic, but it helps you understand the fundamental principle of gravity. The M&M theorem is the financial equivalent of that vacuum. It helps us understand the fundamental principle of value before we start adding the messy complications of the real world. By starting with this simple, elegant idea, we can better understand the complex decisions that company managers make every single day about how to pay for their projects and grow their business. It's not just an abstract theory, it's a foundational tool for thinking clearly about corporate finance. So, the next time you hear someone debating whether a company should issue more stock or take out a huge loan, you can remember the pizza. The real question isn't just how you slice it, but whether things like taxes are making the whole pizza bigger. Thanks so much for watching! If you found this helpful, be sure to hit that like button and subscribe for more videos that break down complex ideas. See you next time.